On again, off again tariffs are making for volatility on Wall Street, which is making for concern among those watching their 401ks, especially those planning to retire soon. Joining us now is Jay Spector, co-CEO and partner of EverVest Financial. Jay, good to see you again. Thanks for joining us.
Nice to see you, Ted. Thank you.
All right, let's start base level here and move up. What is a 401k?
It's a great question. What a 401k is, it's an employer-sponsored retirement plan that many of your viewers might have at their places of work. If they're in the public sector, it might be called a 457 account, or if they're a school teacher, a 403b account. But they do all the same thing for the investor. They let them save for retirement pre-tax or post-tax through a Roth component of the 401k for retirement.
I want to try to get to Roth here in a second, but as far as 401ks in general, how resilient are they to market volatility?
Well, it all depends on what the investor is investing in, because inside the 401k plan, think of the 401k as an envelope. Anything inside that 401k is what they're investing in. Could be in stock mutual funds, could be in bond mutual funds, could be in money market funds, could be on alternative investment funds. So it really depends on the investment mix that the investor is using.
Well, so that said, the recent tariffs and the resulting turmoil on Wall Street, what is that doing to 401ks?
Well, that has really caused havoc for the average investor. There has been a dearth of volatility in the market because of the tariffs and some other things going on in the market with respect to bonds and the 10-year Treasury movement. But that has caused a lot of volatility for investors and caused a lot of concern about whether their funds will be there when they need them for retirement.
Before we go on with the 401ks, you mentioned the Treasury bonds, and that's got a lot of people's attention because you don't usually see bonds moving in that direction when the stocks are going in this direction.
Correct. The bonds are typically a more stable investment for folks, but right now what we've been seeing in the last week or two, you've had the 10-year U.S. Treasury move from 3.91% up to 4.5%, and it's settling right now in the 4.3% range. Bond yields, which is the 4.3% that I mentioned, those move inversely to the bond price. When prices go down, the yield goes up, and conversely, when the yields go up, the value goes down.
So from a distance, it looks like people are kind of getting out of the stock market a little bit. They're coming and going, but a lot of them are going. They're not apparently going to treasuries. Where do they go? Where's the money going?
Well, people are still investing in the stock market. You know, you've seen on the average retail investor an increase in flows to a lot of major exchange traded funds and funds that are out there. So I don't believe the retail investor has left the stock market or is leaving the stock market. They're being a little more cautious. The signals that the 10-year Treasury are throwing out to the investment community are, I would think, more concerning because you have this drastic move in the Treasury bonds. People are requiring more return, more yield, if you will, for the risk that is out there because of the tariffs and other global issues.
And uncertainty, which is a big factor
Correct.
as well. How does uncertainty play in the world of 401ks?
Well, uncertainty reigns supreme. I mean, what the stock market wants is certainty. And when you have a lot of uncertainty, you see a lot of volatility and you see a lot of movement, intraday movement in the stock market where it might be down 300, up 500, down 1,000, and end positive 200. So that type of uncertainty and changing and messaging coming out of Washington, D.C. is causing this volatility we're seeing in the market.
So those with years to go until retirement, I would imagine trying to time the stock market is a losing strategy, and usually exiting the market by way of 401ks can be usually a losing strategy. I get all that. What about those at or near retirement?
So at or near retirement, folks need to take an inventory of what their risk is, what they're comfortable taking in terms of risk. They should also focus on dividend and interest-bearing investments so that you can use that dividend and interest income to smooth out the volatility in the market. Most importantly, folks should stay the course. You cannot time the market, and you cannot time the market in a 401k plan. As I like to say to clients, it's time in the market, not timing the market. So it's really important during volatile times like this to stay the course, focus on your investment plan and the retirement plan that you've put in place.
For those who simply I can't take it anymore, we got to get out of this thing. Are there safe harbors out there for those who are thinking the 401k, I need more, it ain't happening?
Yeah, so there are. People can go to money market funds, they can go to high yield savings accounts. All of those have benefited from the higher interest rates, the higher yields in the bond market. So those are yielding today somewhere around 4%. So that's a safe haven for people if they're really concerned about the risk that they're taking in the stock market.
Okay, you mentioned Roth earlier, and I wanted to get back to that. What is a Roth IRA, and for whom does it make a lot of sense, and for whom does it mean,
Certainly. So a Roth IRA allows investors to save with post-tax money, and the capital gains that they earn on their investments are tax-free when they pull that out in retirement. It's really ideal for younger investors. I would say younger investors up into their 50s, maybe even 60s, depending on what their intent is for that particular account. But really, the real benefit is it goes in with after-tax money, and it allows you to have tax-free gains to use towards retirement.
Interesting. Okay, so Jay, we got the economy growing, the labor market is strong, inflation does seem to be cooling. Economic indicators, for the most part, were looking pretty strong. They're still hanging in there, but how long can we put up with this volatility on Wall Street and this uncertainty as far as tariffs and the future? I mean, we're hearing recession, Jay, and we're hearing it a lot.
Right. I think, right now, like you mentioned, the jobs numbers are strong. Corporate profits seem to still be strong out in the marketplace. The uncertainty is really being driven by this tariff policy that is undetermined or yet to be determined or changes on a daily basis. So I think that's really what's driving the market now. If you look at some of the fundamentals, pretty strong. The Federal Reserve hasn't moved yet to reduce interest rates. They're probably going to stay steady for a while, maybe 2, maybe 3 interest rate cuts this year.
You still think that's going to happen?
It's quite possible. It really depends on where things go and if the economy needs a little bit of a jolt to help it along. But for right now, I think everything is status quo. It's really, I believe, the tariffs that are driving what's going on in the market.
Last question, and again, we're kind of focusing a little bit on those at or near retirement because they seem to be most at risk and they seem to have the most concern. Is it wise to hold off on retirement if you're set for the next month or 2 or something like that?
Yeah, I think you have to evaluate what is important to you as the investor. If you've developed an investment or retirement plan with a variety of different investment vehicles, whether it's Social Security, if you have annuity income, if you have other pension income, or you're generating dividend and interest income from your portfolio, those are reliable income sources. If you're going to rely on growth for your retirement, you might have to take inventory of what that's going to mean for your retirement plan. But by and large, those investors that are using a variety of different investment sources that are more stable during a volatile market, they should be fine to continue with retirement.
Yeah, diversification makes a difference, doesn't it?
Correct.
Jay Spector, EverInvest Financial, always a pleasure. Good to have you here.
Thank you very much.
You bet.